You think of yourselves as Silicon Valley-style disruptors in this world of alternative investments. And I find that intriguing. I know what disruption looks like in Silicon Valley. It's the technology that replaced my rotary dial phone, the one I had as a kid, with a smartphone that I can now put in my pocket. What does disruption look like in private credit or GP stakes?
So, we perhaps fancy ourselves a bit like Silicon Valley, but really it's that we've modeled our business after Silicon Valley, which is to say, those disruptors, what did they really do? What they did is they identified a large market that wasn't being fully or properly served. Said, here, I'm going to provide a superior solution. We manage primarily permanent capital. 97% of our revenue comes from permanent capital vehicles. So we have an entirely different offering to the users of capital, which is we can provide different kinds of duration and different structures from anybody else. And so we said there is a chance to be that disruptor. And then we purposely built a business model that looked a whole lot more like a tech company than financial services. We didn't start and say, our base model is a bank, now how do we become a better bank? We started by saying, here's a necessary service, and if we can do a great job delivering that product, we can earn really attractive risk-adjusted returns. And our business attributes, and this is, I think, a really important point from the point of view of Blue Owl or our shareholders, we look a whole lot like a SaaS business. And people don't normally map technology or Silicon Valley to Wall Street, but we've done this pretty consciously.
Yeah, and our businesses are set up to deliver to our end user and our clients a certain set of services. But if you held our income statement against any other SaaS company, you'd be surprised how similar they are. High growth, recurring revenue, high margin. Hard to tell the difference.
Why is it so much better, and that's what I denote better, to have permanent capital as opposed to the traditional kind of fund that an alternative asset manager, whether it be a private equity firm or a private credit provider, would raise?
Well, every quarter you hear the large asset managers, the alternative managers report earnings. They talk about net AUM growth. That's because they brought in a lot of assets, but a lot of them rolled off. And so to grow, you have to take 2 steps forward and 1 step back. And that's the problem with not having permanent capital. What we have is more of a layer cake. We raise a fund, it stays in place permanently. We raise another fund, you're just adding to another layer in the cake, and it makes growth a lot easier. You're not out there trying to replace or fill a hole from assets that are rolling off.
The way we are paid is to manage for the long term the returns with a current income component. You don't wait 5, 7, 10 years to find out how you're doing with us. Every single quarter, we're making distributions in nearly every product we manage. So whether it's GP solutions or direct lending, they're predicated on capital stability, preservation, predictability, and current income. So you're getting paid every quarter as we manage that capital for you.
And on the products that do charge a carried interest, we did something that's pretty novel. We left the carried interest in the hands of the people that come into work each day. So it's not part of our public company, it's part of the remuneration of our employees. And they love that. It provides great incentives. But the public markets really can't get their head around incentive fees. It's really hard to get your head around a carried interest that can be $1 billion positive one quarter and $1 billion negative the other. And so our business model for our public shareholders was created uniquely to provide an easily understandable income statement. You're not going to see big whips, not negative revenue. How do you have negative revenue? That's what happens when a carried interest unwinds. And that gave public shareholders fits for years. And the likes of Steve Schwartzman and others just bemoaned that the lack of understanding of what's a really valuable thing, carried interest, really aligning for the employee, but really hard for a public shareholder to understand.